when it comes to like a liquid fund structure, right? Like how is it different from a VC fund? Like I remember like we were chatting this like 2-3 weeks ago, and you were like, there's a subscription model and there are like some certain like different things, right? Like can you walk us down that?
Yeah, so a venture model, and this is broad strokes, not always the case, but a venture fund typically it's a closed-end fund, so there's a first close and usually a second and final close where investors have the opportunity to invest into the venture fund, and then it no longer takes additional capital and slowly starts to invest over a period of a couple of years, usually 2 or 3 years.
Right.
And the fund calls capital from their investors in chunks as it needs money to make those investments. And then the investments mature, and then they end up returning, hopefully, capital to investors based on the performance of those investments.
Right. And that's a typical 5 to 7 year cycle.
Yeah, and that's typically, can be as short as 5, it can be as long as 10.
Right.
Typical fund life for venture funds, like 7 or 8 years.
Yeah.
Whereas on the liquid side, it's usually an open-ended fund. So this means investors can come into the fund at any point, and based on the lockup period, can also, once their lockup is over, and that can be as short as a year, can be as long as 3 years, that's typical range. They can subscribe and redeem at any time. And that sort of flexibility is because, as it sounds, a liquid fund is made up of liquid assets, and those are easier to buy and sell, which allows for flexibility to investors to come in and out. Whereas, a venture fund, once it makes venture investments, you can't just very easily sell those. So it's hard for an investor to redeem during the cycle of the fund.
Right. So when it comes to liquid fund, when you've raised certain capital, right, and you're buying assets openly from the market, is it comparable with trading?
Yeah, it's very similar, although you just have a different set of service providers to make it a lot more institutional in terms of investors getting statements and proper reporting and auditing and managing tax. So things like fund administrator, custodian, and that could be institutional custodian or an MPC custody wallet like a Firebox or a Fortify. So yeah, it's just different layers of institutional grade infrastructure to make things more secure and more transparent. But at the end of the day, you're just buying assets that are on the market.
Right.
Usually in larger size, although there's some pretty large whales in crypto.
Yeah.
So there's a lot of individuals that trade their money that are bigger than some funds.
Got it.
And of course, I want to preface, none of this is soliciting investment for my fund. None of this is financial advice or recommendations, and you should consult your own financial advisors for that.
Okay. One question I've always had is, and you mentioned that when it comes to a liquid fund, you pick up assets in big sizes, right? So how do you offload capital, or like how do you offload your own position in an open market? Because I'm assuming when you start selling, that like dumps the price in open market if the size is too big as well, right? Are there like different like strategies of doing that?
Yeah, so it depends on the relative liquidity of a protocol. So something like Solana or Ethereum or Bitcoin or a larger asset, it takes a lot of money to move the price. So, unless you're a huge, massive fund, it's not really going to have much of an impact.
Right.
But lower market cap assets with lower liquidity, it can definitely have that impact. So, there's a couple ways of executing. One of them is a TWAP, time weighted average price, or VWAP, where you're selling little bits slowly to minimize the market impact. Another is you buy or sell a chunk, wait for the market liquidity to kind of reestablish itself in the order books, to refill and then do it again. And that's called a block and walk strategy. But really at the end of the day, it's something that it's actually an advantage for smaller funds versus larger funds, because you can get the relative level of ownership that you want. If you're not a mega $1 billion fund with moving markets a little bit less.